Hello everyone, I am Nidhi Sharma. Welcome to Economics Decoction where I share the essence of economics. So in this video we are going to basically discuss about a very important topic of macroeconomics. Yes, it is all about the national income and GDP. So prior to this video, we have in my channel Economics Decoction, I have shared many videos related to microeconomics specifically based on the consumer behavior and utility analysis. If you have not watched those videos, I am going to provide the links in the description box. Make sure to check those out as well. So if you have not joined my Telegram channel, make sure that you join the Telegram channel as well in order to stay updated regarding my live classes for UGC NET JRF as well as for many other important documents and information related to economics. So yes friends, as I was telling you, if you want to attend my free live classes for UGC NET JRF, you can definitely follow my profile at Unacademy by the name Nidhi Sharma. As you can see, a rising star in the NTA, UGC NET and SET exam category. So you can definitely go ahead, watch my free videos on Unacademy. You can attend my free live classes at Unacademy, and this is going to be very helpful for your journey for cracking JRF in economics. Okay, so make sure to watch the videos live. And if you are preparing to get subscription at Unacademy, which is a very good idea, then you can definitely use my code NSNET to get a 10% discount on all your subscription charges at Unacademy. So yes friends, do not forget to use the code NSNET and get a 10% discount on all your Unacademy subscription charges. And also if you have not subscribed to the Economics Decoctions YouTube channel, make sure to subscribe and hit the bell icon, and also like the video and watch this video till the end in order to get the complete knowledge about the national income and various concepts related to GDP. Now let's begin our today's video. So first of all, let's talk about national income. The total net value of all goods and services produced within the nation over a specified period of time, representing the sum of wages, profits, rents, interest and pension payments to residents of the nation, is basically national income. Okay, so the total net value of all the goods and services that is produced within the nation over a specified period of time. Okay, so here are a few important takeaways from the first line itself. That means national income is calculated for a specified period of time. This is the first thing that you should know. And also it is the total net value of all goods and services produced within a nation over a specified period of time. Fine. It represents the sum of wages, profits, rents, interests and pension payments to residents of the nation. This is the basic idea of national income. So the main concept of national income are GDP, GNP, NNP, that is net national product. GNP is your gross national product. NI, PI, personal income, you can say DI, disposable income, PCI, per capita income, and many more. Okay, so in this video we are going to basically focus on the GDP. Okay, the GDP concept of national income. These different concepts explain about the phenomena of economic activities of the various sectors of the economy. So the phenomena of various sectors of the economy are being represented by these various variables. Okay, then comes the concept of real GDP. The real GDP is the total value of all the final goods and services that an economy produces during a given year, accounting for inflation. So this is the key term when we talk about real GDP. Real GDP is always calculated accounting for the inflation rate prevailing in the economy. Alright. So the real GDP is the total value of all the final goods and services that an economy produces during a given year, accounting for inflation. It is calculated using the prices of selected base year. GDP is calculated on the basis of fixed prices in some year. To find out the real GDP, a base year is chosen when the general price level is normal. That is, it is neither too high nor too low. So according to the base year, the real GDP for a particular year is calculated or estimated. If prices change from one period to the next but actual output does not, the prices have changed from one period to the another, but the actual output has not changed, then the real GDP would remain the same. So your real GDP is going to remain the same. Real GDP reflects changes in real production. So what does real GDP reflect? Real GDP basically reflects the changes in real production, how much output has been produced in the economy, accounting for inflation. Real GDP is a macroeconomic measure of the value of the current economy's output adjusted for price changes, that means either for inflation or for deflation. So when we calculate or when we measure the value of the output produced in an economy considering the impact of inflation or deflation, then it is known as real GDP. Okay, so the real GDP is calculated as real GDP at current prices divided by prices into 100. So real GDP is basically Q into P. Q is the final goods and services produced during an accounting year, and P is the prices prevailing during the base year. It is not the current year. Please be very focused in this area that P refers to the prices prevailing during the base year, not the current prices. Alright? Okay, so real GDP increases only when your Q increases. That means when the output, the total output of the economy increases, only then the real GDP increases, because prices remain constant. So when real GDP increases, there is an increase in the flow of goods and services, other things remaining constant. So if we observe that the real GDP has increased, so we can definitely say that the output produced in an economy has definitely increased. So if the real GDP increases, output or goods and services increases, thus we can definitely say that the quality of life has improved. Okay. So an increase in real GDP is a slight indicator of an improvement in the quality of life as well. However, quality of life improvement is a very holistic and a very major concept. Just by rise in real GDP, we cannot say that the overall quality of life has improved, but yeah, definitely a rise in GDP somewhere or the other indicates an improvement in the quality of life, because more goods are being produced, more production is being done in an economy, more people are getting employed, and thus we can say that since employment is increasing, the income of the people are increasing, the purchasing power of the people are increasing, and thus the quality of life is improving. So this is the idea behind real GDP. Now we will talk about nominal GDP. Nominal GDP is measured on the basis of current prices. So as I told you, in real GDP, the prices that we consider is the base price. But in nominal GDP, the prices that we consider is the current price. That means the current period's price. Nominal values of GDP or other income measures from different time periods can differ due to changes in quantity of goods and services and or changes in general price level. Okay, so if the general price level changes or the quantity of goods changes, then your value of nominal GDP is going to change. As a result, taking price levels or inflation into account, it is necessary when determining if we are really better off or worse off when making comparison between two different time periods. Nominal GDP. Therefore, if prices change from one period to the next but actual output does not, nominal GDP would also change even though output remains constant. So even if your output is constant, if there is a change in price level, then also your nominal GDP is going to change, because while calculating the nominal GDP, we consider the current price level, not the base prices. Okay. So the formula to calculate nominal GDP is real GDP into price index by 100. If there is no inflation or deflation, the nominal GDP will be the same as real GDP. Okay, so at constant prices, when there is neither inflation nor deflation, then your nominal GDP's value is going to be same as the real GDP. Now comes the concept of GDP deflator. GDP deflator is an index of price changes of goods and services included in GDP. It is a price index which is calculated by dividing the nominal GDP in a given year by the real GDP for the same year and multiplying by 100. So when we divide the nominal GDP, that means the GDP at current prices divided by the real GDP, that is the GDP at constant prices or at base prices, into 100, then we get the GDP deflator. It is an index of price changes of goods and services included in the GDP. So that was all about the national income, real GDP, nominal GDP and GDP deflator, and by this we come to the end of this video. Thank you so much for watching. Please subscribe to the channel, join our Telegram channel as well, and follow me on an academy, attend my free live classes, and you are going to crack your JRF very soon. Thank you so much. I'll see you soon in my next video. Till then, keep studying.